Hi, good afternoon. How's everybody?
Hello, Professor. How are you?
How are
How are
you,
you,
Ophelia?
Professor?
How are you, Safia? How are you? Uh,
I'm good. How are you?
good, good, good. Actually, uh, as I said, a human being is uh, a creature that is enslaved to habit. So, also the language, is um, a colloquial, something like greetings, colloquial greetings, colloquial statement. These are all just, habit. I mean, you don't really, actually, I'm not feeling that well, but no, you just, um, so, so I guess I will have to, I'll have to cut the class short, today. But we still need to, because we need to continue with the oh yeah, this one, because yesterday we were basically talking about the yield, right? Yield to maturity, right? And I said, uh, there are two types of yield. Yield to maturity, which is the long-term annualized return, right? I've been telling you from the day one, yield is just another name for return, rate of annualized return, right? And yield to maturity is also the internal rate of return. Internal rate of return is a mathematical term for the discount rate, right? Uh, that makes the left-hand side equal to the right-hand side, right? And of course, if the this rate is internal rate of return, then both sides will have to be equal, and then that means the left hand side, the market price of the bond um, is equal to uh, the present value of all the future cash flow, and that's the only way it has to be. And think about it. If um, uh, finding what is the rational price or intrinsic value of the bond really depends on what discount rate we use, right? And if the discount rate that we use is the yield to maturity, in other words, if then what does that mean? If the discount rate that we use is exactly the yield to maturity, then of course, R is the half-year rate, so it's the yield to maturity divided by 2. Also, this Y is exactly, yield to maturity divided by 2. And if that means if R and Y are the same, right? Uh, what kind of conclusion can we get? Uh, okay, it's already that. Don't do this to me. So if R equals Y, then what? Intrinsic value of the bond is exactly the market price of the bond. In other words, and then if that is the case, what does that mean? The market is in equilibrium.
Professor, I cannot see your screen.
Huh? Oh, I'm sorry. This is what I'm sorry about. Uh, yeah, I'm. I said, I'm not feeling well today, so this is okay. Give me a second. Give me a second. Thank you for mentioning that, because in the previous class, the whole time was not the whole time, but about I guess for about 10-15 minutes, it was the same situation. Nobody mentioned, nobody said anything. So, but thank you for mentioning that. So where am I? So here,
Yes, I
so
only see that
yesterday,
you're clicking and clicking, but I don't see your screen.
okay. So yeah, this is what I'm talking about. Yesterday we were, so basically, the difference between these two formulas is that, this one is to find, B is the unknown, right? To find B, we need to, uh, R needs to be given. In other words, the discount rate must be known. So depending on what kind of discount rate we use, think about it, if the discount rate is too high, then the intrinsic value will be low. If discount rate is too little, too small, then this will be too high. So if you use, too small discount rate, then the valuation can be the valuation can be overvalued, right? The intrinsic value can be overvalued. Uh, or if it is too high, then the valuation can be um, undervalued. So it's a question of, what is the discount rate? And if, uh, again, this formula is for finding the discount rate, which is, and the discount rate in this case, when given the market price, and market price is something you can always look up. Currently, it may not be real time, but you can look up. When you look up, the price is almost, uh, um, real time. The price that you can see on the, like something like Yahoo Finance. Um, and it changes every time there is transaction, right? So that's almost real time. Transaction doesn't necessarily happen, every second. There can be some because the trader, the broker, the broker's trader at the trading floor, they will have to wait for the brokerage firm will, the brokerage firm will huddle or gather the order, buy order and sell order. Buy order. It has to be buy orders must be executed by the lots, by even lot. Lot is a lot is 100 shares. 100 shares is uh, one lot. Okay, so if they have two lots, one lot, even lot. Even means you have 100 shares. The buy order for 100 shares. I mean, if there are 500 buy order for 500 shares, that makes 5 lot. But sometimes there are odd lots. What if there is no the orders come in piecemeal, not like 500 200 shares or 500 shares. No, it could be like some people may place a buy order for 33 shares or 23 shares, 27 shares, 57 shares. Well, then they they group the orders together, gather the shares together. They will have to make even lot by there's a order for 57 shares, and then you wait for the orders for 43 shares or whatever number of shares to make an even lot. And then sometimes and then look for the match on the sell side, right? And then sometimes the order may not be in even lot. It could be like two lots and 33 shares. Still, if there is a matching sell order, then the transaction will happen. So because of that, the transaction doesn't necessarily happen every second. But all these different brokers, with numerous clients. I mean, some orders happen now, and the next order may happen. Next order may be executed. 10 minutes later, but there can be still another transaction by another broker. Two other, another broker has, also a buy order, and there's another broker with a sell order. So it doesn't have to be broker A and B only. When there is a long gap for broker A to execute transaction, and there's broker B and C that, for broker A to have the next transaction, the gap may be 10 minutes or 15 minutes, but in the meantime there is broker B and broker C, or broker B has both matching buy and sell order within the brokerage. So transactions can happen sporadically or almost continuously every second. But the point is, when this price is known, of course, as I said, you can look up the price. Just go to Yahoo Finance, and constantly the prices are changing, because that means there's transaction constantly, and the price of the last transaction is there. It was just 1 minute ago. So just like that, you can look up the current market price, and if the current market price is given, then what makes the left-hand side, both sides, equal? I told you that's internal rate of return. Mathematical term for that is internal rate of return. And then we can find that internal rate of return, right? This is given, and all the other things are known. Coupon is known, N is known. So the only unknown is this, the discount rate, which is internal rate of return. And if you solve for that, that would be internal rate of return, right? That is the rate that makes the left-hand side equal to the right-hand side. And then, so, and that, because this is half your rate, that times 2 is the yield to maturity. Now think about it. So that's what I'm saying. If R is the discount rate we use here is equal to if it happens to be the half-year yield, then the intrinsic value must be equal to the market price of the bond. Okay. So that means then there will be no underpricing or overpricing, right? Market price is, correct, exactly valued, or exactly valued. And if that is the case, then the market is in equilibrium. The market for this particular bond is in equilibrium. Of course, the equilibrium is a very fleeting concept, because equilibrium exists only, it's a transitory thing. It doesn't stay there. It doesn't stay there for a long time. Equilibrium will be disturbed, instantaneously again. So that's why in the short run there is constantly mispricing. Okay, and the mispricing is that sounds like a bad thing, but actually mispricing is not a bad thing, because if uh, without mispricing, then there is no profit opportunity. Why? Think about it. If the intrinsic value is always, in equilibrium, I mean, if the bond price is in equilibrium, that means, if the intrinsic value is equal to the market price, then there is no way you can make profit. Why? In the short term. Why? You make profit because um, right. Now think about it. How do you make profit in the bond market or in the stock market? Huh? They always say, uh, everlasting, um, everlasting adage, or everlasting strategy. I mean, this fundamental strategy is what? Uh, Buy low, sell high. Of course, who doesn't know that? Buy low, sell high. But even if you bought low, but if the price falls, right, below the price you paid for, um, the price you paid for that, asset, for that, security, then, there's no way you can sell high, right? Of course, in the long run, okay, as long as the economy is growing, uh, what does that mean? Economy growing means, everybody, everything, everybody's income is growing on average, economy's production capacity is growing. I mean, if the economy is growing at 5%, that means on average, the output capacity, the production capacity of the economy is growing on average at 5% annually, right? And then that means GDP on average, output is growing at 5% on average, right? So as the economy is growing, then because production capacity is growing on average for every company, right? Their revenue is also growing on average at about 5%. Of course, individually it will be all different, but on average, right, across the board. And that means the profit is also growing on average at about 5%. So in the long run, as long as the economy is growing, you don't lose in the stock market, because think about it. Back in 1981, in the long run, buy and hold strategy is also called, uh, uh, long strategy. Long means, buy and hold, right? That's long. Um, and in the long run, but you have to have patience, right? Uh, think about it. Back in 1981, Apple went public in 81, and when it went public, it was like I don't know how much it was, maybe $10 per share. 19, that was 1981. 40 years later, Apple is what? How much is Apple now? 200 something, I think. You might say, oh, that's not that much. Look, no, it was Apple Apple had many splits, right? Uh, Apple had many splits over the years. Okay, it's 150 today, so it dropped. Let's see. Um, where's the chart? Big chart. Okay. So that was just, that looked bad, but that's just intraday, right? Yesterday was, 151. And today, this daily. But let's take a look at annual, like 1 year, and then maximum. So each notch is month, year, which is 12 months. 1982, 1981, right? And how much was it in 1981? You see this? And then actually, oh, it's hard to keep it there. Okay. All right, just about here. Okay, open, high, low, close. These are like 18 cents. No, no, no. You have to understand that there has been, see what that means? Stock split, splits 2 to 1, 2 to 1, and even in recent years, 2000, it was like 2014, and I don't know why it's. So let's do. So if I remember correctly, in about 2014, they uh, they had the most recent split was in 2014, and at the time, Apple was like, I bought Apple 10 shares of Apple in 2010, 2012, I believe, and at the time it was 2012 or 2014. I don't. I paid, it was $600, and I sold it at 660. So that was like, just so maybe let's say I bought it in 2012. So, $6,000 because I bought 10 shares and then sold in 2014 at 660. So that was, I just realized 10% gain. I shouldn't have sold it because I just wanted to realize the gain, because until you sell it, it's only paper gain, right? But then after I sold, it went to something like 680 or whatever. I don't remember exactly, and they had 7-to-1 split. Just a couple of months after I sold, uh, uh, they split. Apple split 7-to-1. So um, 7 to 1, I bet. So each share was then, $80, $89 or $90 or something like that. Think about it, just divide 700 by 8. It was probably 8 to 1. So then, if it is 8 to 1, yeah, if I kept on, if I didn't sell, I would have had from 10 shares, it would have increased. I would have had 80 shares. Well, of course, the total value would be the same because you're just dividing it by total value would be the same. But with 80 shares of Apple, and from that, from $80, you got to think about it. The latest one was in 2014 or 2016 maybe, and I bought it at, and then since from $80, then it went back to it was 200 something. Then probably they had another split after that. Since 2014 or 16, they had another split. So then, but after split, then they have to adjust the price. They will have to adjust. In other words, otherwise the data will look like there was a big shift. Think about it. If you understand what I'm talking about, if that stock split happened on September 1st of 2016, let's say if the stock split happened, that means until August 31st, it was, $660. Apple was $660. And suddenly one day, it is $80 or $90. The next day it is, right, $89. Then if you plot it and, if you connect those dots, the plots, the resulting graph would look like suddenly from 660, 89, it looks like there was like a stock market crash and Apple lost, suddenly, like 500, Apple lost, $510, overnight, right? The graph, if just looking at the data, then it would look like that. You understand what I'm talking about? Anybody?
Yes.
Yes.
Okay. Yeah. And if you are a market participant and if you have been watching, what's going on with Apple, you would understand it's, yeah, because there was a stock split. But suppose you're an alien that just, arrived, for someone who totally has no idea about no understanding, no knowledge of stock split that happened on September 1st. Suppose an alien like that arrived, in New York City in a spaceship, and the alien went to the New York Stock Exchange and looked up, so it's actually NASDAQ. I think Apple is still listed in NASDAQ. And looked up the data, right? And then an alien with no knowledge of stock split, right? Apple's stock split, would be shocked, right? To find that the price drop was like such a drastic price drop. So something must have happened. There must have been this company must have crashed overnight. No, but you understand, there was no such thing. It was stock split. So what? Um, so that's why they need to adjust the price, to reflect, I mean, uh, so the stock split happened here, then everything, think about it. If the stock split happened here, let's say, then prior to that, the price was probably somewhere here, right? So uh, then, everything prior to, all the prices prior to the stock split will be recalibrated, or, recalibrated, so that it would, the data will have continuity, smooth continuity. Okay, you understand? So that's why, because there has been several splits. So let's see. See, if I, if the time, if I, redefine the timeline to 5 years, in the last 5 years, there were two stock splits. You see, one here, one here. The most recent one was a 4-to-1 split on August 30th. I remember this because, August 31st, 2020. And then after the split, right, and the price was then, so prior to stock split, the price was like, again, 400 something, and then, they did, a 4-to-1 split. So then, yeah, 4-to-1 split, and you can tell after 4-to-1 split, the price is like 129. So that means, prior to stock split, the price was at least 480 something. Makes sense? 490 something. And then in the split was on June 9th of, yeah, this is the split that I'm talking about. I sold before. That was June 9th of 2014. So my memory was correct. So I bought it, uh, in 2012, and then sold in 2014, about a month before the split. So I sold in May, I believe. And then there was a 7-to-1 split. Okay. And you might say, oh, after split, it was only $23. No, look, it was like $89 or something like that. It was then recalibrated again after this split, right? After the split here, it was recalibrated. Okay. And all these D's mean, dividends paid, right? They did, they paid dividends. Now, of course, throughout the life of Apple, there was a long period when, dividends were not paid, 1990s. So that's why I'm saying dividend is not it's not a must. Dividend is not an obligation. So you can tell. So you see dividends here, but there was no dividend during this 1980s. There was no dividends, and from like 87, 85, 86, they paid dividends. But 94, that was the last time, and then there was a long gap, 95 through until when? 95 through 2011, 2010, they didn't pay. For 15 years, they didn't pay dividends. And so when they were not paying dividends, what does that mean? They needed to plow back everything for reinvestment. They don't pay out dividends, and whatever, all of the profit goes into all of the profit is plowed back into the company's growth. And then, since 2011, they started to pay dividends again. So looking at this, if you bought Apple 40 years ago, you were not around at the time, but I was 20 something. At 81, I was 20. uh, and at the time, a college student, sophomore, sophomore to college, junior, had no idea. I was a liberal arts major. No idea about Apple. No, no money to invest. But if if somebody invents a time machine, I would like to travel back those days. I will just, whatever I can grab, maybe $10,000, $10,000, or $100,000, and travel back to 1981, buy Apple. Of course, I should be able to come back because I don't want to relive my 20s and 30s and 40s and 50s all over again. It's going to be, very difficult, looking back, turbulent time, especially 20s and my 20s and 30s were a turbulent time, so I don't want to go through that again. So if I can come back, and if I bought, look, with $100,000, and I believe, when Apple was, first went public, Apple first went public in 81. It was probably, IPO price was probably $10. And if it was $100,000, you could buy 10,000 of them, 10,000, right? And what is the return if you think about it? Currently 150, right? 150, and it was 10 cents. I mean, it was not 10 cents. It was $10. But I told you, adjusting for the stock splits, then it was 10 cents. Then think about it. It's not a difficult thing. It's easy. What kind of return was that? So 150, right, minus 10 cents, 0.1, right, divided by 0.1, right, 1,499 times, in terms of percentage, right, in terms of percentage, two more, that's 14,099, 14,990. What is that? In terms of percentage, right? Two zeros, so that will be 14,000. No, 149,900%. No matter what, I would be my $100,000 would be now 1,499 times, right? What is that? 100,000 times, one. So 1,000, 100,000, just times 100,000. Just just add 5 zeros, right? 149 million, 149 million. Right. If only, if only I can travel back in time. But this is really, if you hold it for long run, and as long as the economy is growing, of course, Apple outdid Apple more than Apple outgrew the average economic growth rate. But even if it was an Apple, right? If it was even Microsoft, or even any any company that is still around, General Motors, GM, Ford, whatever, 3M, the companies that were around in 1981 and still around in 2021. I would have, if I invested, even, $10,000, it would be, like at least, 1,000 times greater now. So that's patience, and power of compounding. Of course, there was time, 40 years, right? But even uh, you are not, you're not, you haven't been around that long. But so let's say, since even, it was what, let's say 2000. So let's say you were born in 2000. Still in 2000, what was Apple? Uh, 38 cents. Of course, that's after all of these adjustment for stock splits. But uh, it was probably uh, see, compared to in 1981 it is like 10 cents. 81 and 81 is like 10 cents. So that means at least three times that, right? If 1981, it was, if 1981 it was 10 cents, at least four times, so it must have been like at least, $40. I think it was more than $40. It's just because of the this consecutive, stock splits. But anyway, after making adjustment for that, uh, in 2000, if you were born in 2000, and if your parents bought uh, uh, like 100 shares of Apple, that would have cost 4,000, and by now you would have been, right, 100 that 4,000 would be, anyway, the long hold buy and hold strategy is definitely, yeah. But then, you don't have that patience. A lot of people just, are day traders, and then for day traders, all the more, this is the thing. Um, they are all looking for mispricing in the market. I mean, it took so much time to explain this. Then there are three possibilities, right? Two possibilities. What am I talking about? R being greater than Y, or being less than, Y. Then what does that mean? Then intrinsic value will be less than the market price. And intrinsic value in this case will be greater than the market price, or the market price is less than the intrinsic value. So if this is the case, what is this called? It's overvalued. No. What am I talking? Yeah, because um, you're using higher discount rate than the so it will be then this is if it's the other way around, it's undervalued. So these are called mispricing, right? In other words, the price is not equilibrium, right? And this equilibrium, or this my tongue is tight. This equilibrium is the thing that causes the mispricing, and mispricing offers a profit opportunity. Why? Uh, if the market price is, we talked about this yesterday. Uh, if market is undervaluing, then uh, anything undervalued, valued less than the intrinsic value, uh, is a buy opportunity, isn't it right? You find a house that is, for everything it's got, it's undervalued, then this is a good buy, because sooner or later, uh, sooner or later, um, the buyers will, the market participants will realize that this is undervalued, and they will try to buy this. I mean, as long as until think about it, that incentive, right there, you can buy this and sell it at intrinsic, even at intrinsic value. They all, or even slightly less than intrinsic value, as long as there is a room for. I mean, the price won't go up above the intrinsic value, because once it reaches intrinsic value, then there's no more room for profit, right? There's no more room for profit, so there's no incentive to uh, for to buy that, right? Um, so that's a profit opportunity. And if it is overvalued, uh, and if you already own it, you gotta sell it, because while it is overvalued, you still, by selling it, you make profit, but it won't go down. As you sell, the price will start to go down. The price will stop at the intrinsic value, and as the market realizes that there's no more profit opportunity, then. And another thing is, that's when you own this asset already. That's when you own this asset. You sell it when you own it, if you own it. But if you don't own it, then you might think, what can I do? I mean, if you don't own it, that's just out of the question. I can't. But even when you don't own that asset, you can still sell it. It's called a short sell. Short sell, right? And because of the short sell, that was a big, short sell is a, uh, they argue, sometimes they argue in favor of short sell. There are, uh, yeah, theoretically, there are benefits of short sell, allowing short sell, but short sell is usually, uh, a disaster. It causes disaster to the economy. Um, I don't know if you saw the movie Big Short. Um, I I haven't seen it yet, but I know what it is about. It's about 2008 financial crisis and uh, the mathematician or physics, physicist, not physician, physicist, meaning a PhD in physics. I mean, PhD in mathematics or PhD in physics, PhD in economics or PhD in finance. They can do all, they can pretty much, do the same thing as far as the stock market is concerned. Pretty much, I said pretty much the same thing, not exactly the same thing. And this guy who was working for a small asset management firm figured out that all these signals, the mortgage-backed securities, collateralized, mortgage securities, the too much bubble in the housing market and the mortgage backed securities, collateralized, mortgage backed securities are blowing up, and he knew that it's gonna burst. The bubble's gonna burst. Sooner or later. So what did he do? He actually took a short position, meaning you sell. Think about it. He knows that the market's gonna drop. So what are you? Stock market will crash. So what are you gonna do? If you can, usually you will have to buy low and later you sell high. But that's the only way. But if the market crashes and whatever you paid, or whatever you bought it for, the market price will be lower than that. Then there's no exit. I mean, usually people panic and they sell below the price they paid for, and then price they pay. Then it's only loss, realized loss. But but there's a way you can sell what you don't have, what you don't own. You can sell, and if you're predicting that the market's gonna crash, then you sell now, and when market crashes, you buy it back. Then at whatever price you buy it back, it will be lower than the price you sold it. The question, so you effectively bought low and sold high, but it happened in reverse order, in reverse chronological order. You sold first and bought it back low. You sold first high and bought it back low. Okay, that's called a short sale, and that's a crazy thing actually. But then how can you do that? How can you sell what you don't own? Well, usually, think about it. I have, after I sold, Apple, that was in 2016 or 14. And then, I bought, and for a long time, I didn't have a chance to get it back because Apple was then very expensive. And after the split, I believe, last year, was it that time? Yeah, I think, after Apple had another split in 2020, I bought probably 20 shares or 30 shares, whatever. But think about it. When you have stock, does that mean you have the stocks delivered to your house, to your place? Huh? When you own stocks, are they with you? Are they in your house? Huh? Bond or stock, when you own bond or stock, are they with you? Physically with you? No one answers.
No.
No,
No.
no, of course not. It's held within the brokerage house. So you have to use a brokerage firm, whether it is online brokerage, Robinhood is on, Ameritrade also online, E-Trade online. But it's just like your money. If you have $10,000, is it with you? I mean, nobody. Some people keep $10,000 under their mattress. Why? That's Some people do that to avoid taxes, to evade taxes. I mean, if you have like 10,000, 10,000 is not a big. Let's say you have $100,000 and in the bank, and uh, uh, it must be accounted for tax purpose, isn't that right? Where did that $100,000 came from? Where did that come from? And if it is your income, from your income, did you pay taxes on that? If you have paid taxes on them, that's fine. But if that wasn't if tax wasn't paid on that $100,000, then you're in trouble, right? Of course, you'll have to pay taxes, and then no problem. But to avoid taxes, some people keep a huge amount of money under the mattress. But if if there's a thief and who finds out you're a dead duck, and if there's a fire, you're a dead duck, isn't that right? Huh? So just like your money isn't with you, but with the bank, your stocks, your bonds are not with you. They are uh, with the brokerage firm. It's called, held under street name. What does that mean? Those stocks and bonds are held under the street address of the brokerage firm, right? Hence, held under the street name. So think about it. What do these brokerage firms do? Anyway, your money doesn't have your name on it. Isn't that right? Your money in the bank, if you have $10,000 in the bank, your money doesn't have your name on it. They don't write your name on it. So that's ridiculous. They don't put. So what does the bank do with your money? They lend it. Just like that, the bonds and stocks that you own, they don't have your name written on it, because anyway, you will sell it whenever. Nobody writes their name on, if ever the price is right, you will sell. So you don't. So the brokerage firm is free to lend it. You understand? The brokerage firm is free to lend it. All they need to do is, if you have 100 shares of Apple, they will just need to allocate 100 shares in your name. They will just need to, at the end of the day, the total number of shares must be maintained, right? Total number of shares must be the same at the end of the day, right? Makes sense? So you can borrow those shares. You can borrow those stocks from the brokerage firm and sell at the current market price. And if you're sure the market's going to crash, then you buy back. And then you buy back at the plunged price, plummeted price. So you're basically, and when you first sold, so you have money. So with that money, I mean, with a fraction of the money the proceeds from sale of the stocks, with the fraction of that, you buy back. Makes sense? You buy back. So, and then you return the stocks to the brokerage firm with some interest. They're not gonna lend it to you for free, right? So you pay interest, and that's how it works, right? That's what he did in that movie Big Short, basically, did it on a massive scale. And what, 2008, the financial market crashed, and he made a lot of money. But it doesn't happen, every day. I mean, in other words, through the short sale or short sale. It's not short sale is more like a real estate short sale. It's called short sale. Even the noun is short sale, not short sale. Um, uh, the verb is either sell short or just short sell, and the noun is or just short. Noun is short sell, not short sale. Okay, short sale is something that they do in the real estate market. But anyway, the point is, yeah, this is what this is basically what you want to find. I mean, if the market is correctly priced, if the market is in equilibrium, there is no profit opportunity. You can't make profit, right? In an efficient market, if the market is efficient, what does that mean? The intrinsic value must be equal to the market price, and that's the market efficiency. I mean, market is so if the market is efficient, it sounds like a very good thing. It sounds like a nice thing. Market efficiency sounds like a great thing, but actually it means you can't make money, right? So to make money in the short run, it's better that the market has imperfect efficiency, or rather slightly inefficient. I mean, the market cannot be completely inefficient, but if the market is slightly inefficient, that gives rise to a profit opportunity. Make sense? All right. So that brings us. So then I would like to do just one more thing, because we are as I said earlier, I'm not that I'm not that feeling well today. So I'm gonna have to break up the class a little sooner, so we don't have that much time. And then I would like to introduce you, because there are still things that we haven't talked about. First of all, TIPS, Treasury Inflation Protected Securities, Treasury securities and inflation municipal bonds and all. But that was delivered through the main lecture. And then coal, right? What is coal? But this was delivered by main lecture. So if maybe, I don't know, if we have only 2 more days left, so probably no time for going over everything. But let me quickly give you an example of that problem. TIPS. Okay, so let's take a look at this. Consider a 3.75% TIPS with CPI reference of 186.1. CPI is a very broad measure of inflation. It's consumer price index. There are 3 broad measures. CPI and PPI produce a price index. And think about it, CPI is a good measure of and a very broad measure of inflation. And there are 2 types of inflation. One is a demand pull inflation. The other one is cost push inflation. Remember, demand pull inflation is a very typical case of inflation, and it's a good. I said it's there are good inflation and bad inflation. Of course, good inflation is what if it is accelerated inflation, it's not a good inflation. But if it is inflation is about 2%, if inflation is about 2%, I told you that is, and if it is especially due to strong demand, it's it's a positive signal. It's a positive sign. Because it's a positive signal. It's a sign of vibrant economy, right? On the other end, so CPI, because it's consumer price index, um, I wouldn't say it is only the measure of demand pull. Demand pull is a good. Cost pushes the inflation due to production cost. So input cost. If input cost goes, if cost of steel plate goes up, cost of raw materials go up, and we are now seeing actually currently experiencing cost push. Why cost push inflation? Why you've heard probably microchips. Microchips are not the due to pandemic the supply chain has suffered. You can't really uh, and even during the pandemic, the demand has been very strong because productivity didn't go down. I mean, basically, everybody works, from home. I mean, it's not like, or during the early days of pandemic, those who work in the restaurant or hospitality industry, or they lost jobs, but then they can't, they continue to spend because of the stimulus check. I, gave you an anecdote of a woman who used to make about 20, $23,000 a year. It's now making, without working, making 60 something thousand dollars a year, you know, purely by stimulus checks. So then the economy wouldn't die. And then those who don't have to work physically, right? I mean, those who don't have to report to work, and everyone works from home. So productivity didn't go down. And then so but supply chain of like microchips, and microchips are now in everything, and cars these days, cars have to have microchips in it, the memory system, computer memory. And then because of shortage of microchip supply, then the production of cars have been halted. That's because of that. The used car prices have gone up. Even the new car prices are up. And so PPI is producer price index, is a good measure of cost push, because it's producer price, which is the raw material. And then the third one is GDP deflator, which is GDP deflator is actually a nominal GDP divided by real GDP. But think about it. It's like chicken or egg. Which one is first, chicken or egg? I mean, to find real GDP, you have to know some kind of GDP deflator. So I'm not going to get to that. And there's also PCE, core CPI, core consumer price, consumer expenditure index. So that's called PCE. index. But CPI is the most. So CPI of 100 is the base year. Because base year's price level must be 100. Price index must be 100. So if the CPI is 186, that means whatever the reference, whatever the current year is, compared to the base year, the price level is almost twice. Price level is twice as high. But the base year is usually 1984. 1984 is the base year. I mean, for all and that has been for a long time. And 1984 was 100 base. So, and then more recently, then they used 1997 as the base year. But anyway, if the base if 1997 is the base year, then whatever. If this is the current year, right? Then what does that mean? Compared to 1997, the price level this in the current year is almost 86% greater. Anyway, that's what. So tips is basically making adjustment. What tips does is make adjustment for inflation so that your maturity value and the par value and the par value will be adjusted so that the as par value gets adjusted, then the coupon interest payment will get adjusted for inflation. So what was the capital gains of the tips in dollars? So let's capital gains, then that's the par value change, right? If the par value changes, then if the par value goes up, there is definitely a capital gains. This part two, what was the capital gains of tips in percentage? So let's take a look. So I did this problem here, and I think that is this one. Okay, number 10, 7.19, that's 7.19, so that's the same thing. Oh, what is that? So, the face value is 1,000, right? Face value is 1,000. That's original face value, original par value. Coupon rate is this. CPI in year time 0. I mean, this is not the base year. As I said, base year is like, CPI of the base year is 100. But this is the CPI of the year where our timeline starts, right? CPI of the year where our timeline begins. So at that point, it was 186, and then 1 year later it was 193. Another year later is 200.1. So then we adjust the this is maturity value, right? We adjust maturity value by the increase in CPI. Think about it. This minus this, right? This minus this divided by this will give you percentage, right? Percentage increase. So what I did was simply, or well, you can do even, this will be one. If you divide this by this, that will give you the gross rate. In other words, let me do it. Think about it. What is this? This is a gross growth rate of the inflation. So in other words, the net inflation is 3.71%, 3.71. So if you're adjusting for net inflation, you will be multiplying this by 1 plus 1 plus 0.0371. But again, that is, what is that? That is, 1 plus 3.71% is, 103.71. So why we don't need to work with, net inflation. You can just work with the gross inflation, and then you get, obviously, then you will get this, right? And then in the second year, from this to this, so you can make two ways. You can make adjustment in two ways. One, you can find inflation between end of year one and end of year two, which is the same thing. I'll just drag it here, and there is 3.68% inflation over between year one and year two, right? Or during year two, right? And simply then I can simply multiply this by this. Okay. And that's what I did. Another thing is, I can also do it like, okay, starting from this, what happened, in year one, this was the inflation. In year two, this was the inflation. What do you get? You get the same thing, right? Okay. What's the capital gains? Capital gains, look, between year one and year two, right? There was, it's simple. There was, the capital gains. Now you might wonder, isn't it 1,000? No. 1,000 was the just the face value. 1,000 is the face value, and because of the inflation, I mean, you would because of inflation, the adjustment for inflation has been made, right? So actually, after adjusting for inflation, this was the maturity value at the end of year one, maturity value at the end of year two. So capital gains between 2 years is this. Then growth rate in inflation. I mean, not the growth rate in inflation. The capital gains, return. This capital gains in rate of return, so rate of return on investment is capital gains, right, divided by initial investment. Okay, so currently in this example, there is no coupon assumed. No coupon is assumed. And of course, it could be possible because there are zero coupon bonds. There are zero coupon bonds. And if this is a zero coupon bond, that perfectly fits the that scenario. Okay. All righty. So where was I? All right. So as I said, I will let you go a little early today because I have to first take care of my health. Um, any questions so far? Any questions? Any questions?
No.
No.
All righty. All righty. Thank you. I hope you have enjoyed today's session. And uh, don't forget, quiz 2, I believe quiz 2 is due today, right? Don't
Yes.
forget, quiz 2 is due today. All righty. Uh, take care. And I believe, final instruction has been already issued. So take care, and I will see you tomorrow. Okay?
How many questions are we gonna have on the last quiz?
Maybe it won't be more than 33 questions. It could
More than 33?
either 25 or 33. Okay?
Okay, because the second quiz was 50, 52, I think.
What?
Question.
Was there? It must have been. Okay. I
That
don't
was
know.
a lot.
Final.
120 minutes? Oh my God.
Was there 50 questions in the second quiz?
In the second quiz, yeah.
Well,
52.
then you had 120 minutes. 120 minutes,
Yeah.
right? So that could have been a little tight, but final it would be probably 33 questions. All righty, so I will stop recording and sign out. Uh, take care, and I will see you guys tomorrow.
Uh,
Okay?
by the way,
Yeah.
Professor, Abraham couldn't attend the class today because he had an appointment for the COVID vaccine.
When?
Abraham.
Abraham.
Yes,
Oh, he said he couldn't attend because of he was taking
the COVID vaccine.
the vaccine. Okay. Yeah. Okay, but whatever I go by, whatever is in the forum because that's the sign-in sheet. I mean,
Yeah, that's
yeah. But thank you for letting me know. All right. Take care, everyone.
Thank you so
All
much.
right.
Have a good night. Have a good night, everyone.
Night. Good night.